Today, I'm going to reveal my entire investment strategy all in one video. I'm gonna share a lot of stocks I never talked about before, something around options, since many of you asked me, how do you do options? Options are too risky, and there's a massive misunderstanding around the subject. It's a very different strategy from just buying quality stocks and holding them forever. It's more about understanding market cycles and many different things. A lot of insightful stuff, I promise. But this is a strategy that has allowed me to generate 31% so far this year, 54% last year in 2024. I share all my returns on X, and my average return over the last 4 years has been 34%. And now I can finally talk about this strategy because I actually have proof from my own broker that it actually works. And this is my portfolio performance in the blue versus the NASDAQ in the green. And if you look at Q1, when we had the major pullback that supposedly no one was expecting it, although I was talking about it, I went down 50% less on the market. But on the way up, I'm just killing the NASDAQ right now. I'm up like 5 or 6 times more than the NASDAQ. So it's not easy to be down less than the market on the way down, but to kill the market on the way up. Most investors, they buy ARK Innovation stocks. They do well on the way up, but they get killed on the way down. But not going down much when the market's going down and killing the market on the way up takes a very different strategy, something very special. And you don't need options. I did all of that this year with 0 options. So I'm going to talk about all of that today. Very insightful. If you do enjoy it, all I'm asking is please press the like button and let me know what you think in the comments. And again, I've been not feeling too well lately, so that's why I can't talk as clearly as I normally would. So I hope you enjoy it. But before I get into my strategy, I have to talk about 3 basic principles that I follow that's going to set the ground for me to explain what I do with everything and give you examples and all those things. But the first one, which is a very important one, I don't marry my stocks. I don't develop any emotional attachment to my stocks. I can love a company, talk about it all day, do research on the stock. It's like the best thing ever. And in 2 hours, I could sell it if I find something better. For me, I don't care about any of my stocks. I couldn't care less. I'm in this game to make money. If I have a stock and I like it, and I find something better, I would be willing to sell the stock for something that's much, much better, that could give me much better return. So this is a major part of my strategy, is not marrying my stocks and being able to walk away from any stock at any time in a split second if I find that the thesis is changing. So if the management is making a mistake, I don't get emotional and I exit, or if I find a better opportunity. This is very important. The second one is I'm willing to do whatever it takes to generate returns. So I don't really follow narratives. Most investors, they are more about the narrative, like whatever they believe is right, than trying to make money in the market. So they believe, oh, I'm a value investor, you're a growth investor. You know, this is not what Warren Buffett does, or this is not whatever. But if you see an opportunity to make money, why are you skipping it? So to me, there's nothing wrong with that. But for me personally, I will do whatever it takes to make money. Growth stocks, value stocks, options, cryptocurrency. I don't own any crypto. But if you convince me on Ethereum, maybe I'm going to buy Ethereum, or maybe Tom Lee's stock or something. If I can make money. We're all in the market to make money, guys. We're not here to follow narratives and to have all these feelings. We're in the market to make money. And that's what I focus on whenever I'm trying to pick stocks. And that's an important one. And it's not for everyone. But the last one, which is also the most important one by far, is position sizing is more important than picking stocks. And this one, always people find it weird, and maybe I shouldn't put it this way. But for me, I follow Stanley Druckenmiller's principle, where he talks about that it's not much about how much you're right or if you're wrong, but how much money you make when you're right and how much you lose when you're wrong. So for me personally, I do my research. I like the company. If it's risky, I buy a small position. Because if I'm right, I'm going to make a lot of money. But if I'm wrong, I don't lose too much. I focus more on how much I'm going to make and how much I could potentially lose versus overthinking about every tiny detail in the income statement and every tiny detail in the balance sheet. I look at all those things, but I try my best to structure the right setup in terms of risk versus reward, so how much I could make versus how much I could lose. If the delta between the two, the difference between the two is huge, then I'm all in anytime. Anytime I could risk 0.5% of my portfolio to make 10, 20x. I don't need to know every detail. I don't need to know the company like the CEO knows it. I'm gonna do my research. But if you think about it, you're risking 0.5% to make up to 20x. That's to me an amazing bet. And that's why I have those bets in my portfolio, even though I don't understand every detail about the company. Because if I'm wrong, I'm gonna lose 0.5% and I move on. They're very simple. But if I'm right, I'm gonna make 20x. So that's how I think about it. Now, in terms of my strategy, this is how I would put it in terms of 4 different categories. I'm gonna explain each one, tell you how I do it, give you examples. I'm gonna give you all of it just in one video. Now, the first one, it says buy and hold forever. Now, before I get started, that my target return in the market is to generate 20 to 25% annual return. This is my target. So a double every 3 years is around 23, 24% annual return. So my target is 20, 25%. I was able to exceed it with 34%, but this is my target when I'm picking stocks. Now, 50% of my portfolio is what I would call buy and hold forever quality stocks. So those are amazing, high quality companies that are buys and hold forevers, but those stocks should have the potential to generate at least 20% a year. And the main way you can make sure that they generate 20% a year is if they're growing their own earnings at 20%. So if the company does not face a multiple expansion or a multiple contraction, but they can grow earnings 20% for the next 10, 15, 20 years, then you will likely get a 20% annual return. And that's how you have to think about it. Now, the trick is those stocks are not in the big 7. Most people believe they are. The big 7 are amazing companies. They cannot grow earnings 20% forever. Why? Because they don't have as much control over that as you believe. So I want a company that has a lot of control over how much they can grow. Some companies, for example, like what I own, is 30% of my portfolio in one stock. And this company, they just do acquisitions. They take the free cash flow, do acquisitions, they grow 20% a year, 25%, and they can do it for the next 20, 30, 40 years. Maybe they get too big someday, but this is a way where the company has control over their growth. Some companies, they buy back stock 8% a year, and they grow earnings or revenues 12%, you get a 20% annual return. But I talked about a company like Brookfield or Brookfield Asset Management, where you have Bruce Flatt as a CEO. They call him the Warren Buffett of Canada, and it has returned 18% a year since 1994. And BN itself is telling you that they expect to generate a 21% CAGR in their own earnings metric from now to 2029. So if you don't overpay for Brookfield, you're likely going to get a 21% annual return. And Brookfield has a lot of control over how much they can grow. So this is an example of a stock that's outside the big 7 that has control over how much and how fast they can compound capital. It's very different from a typical big 7 company. But this is what I would put for, you could say, 50% of my portfolio, which is mainly buy and hold forever quality companies. I want to own them for the long term, as long as the thesis is intact, and I just leave them alone. Okay? Now, 25% is in growth. And again, guys, I'm not putting specific percentages. I'm just putting rough estimates. That changes all the time. But in growth stocks, I actually did a video and I explained to you how I pick growth companies. It's in a 15-minute video, and it should have gotten way more views. It's sad that it didn't get as many views because I shared, again, a lot of secrets in terms of market cycles that most people don't even know they exist. So you go and watch the video, it's gonna explain it to you. But I would give you a stock like Robinhood. Robinhood is a stock that I own. It's down a little bit over the last few days. It could potentially go down even more. It's looking very weak. But Robinhood is an example of a growth stock that I want to own for the long term. They have 26.5 million funded customers. All the new generations, they're all in Robinhood. But Robinhood is trading at 58 times earnings. Earnings, that might seem expensive at 58 times. But the company is growing earnings at 100%. So 100% growth for 58 times Is that too expensive? It's not expensive at all. And if you study Robinhood, you know that next year's earnings growth will likely be in the 40-50% range. So you're paying 58 times, but you're getting massive earnings per share growth that's only getting started. So this is another one where it's a buy and hold forever, not just mainly with growth stocks. Same thing with HEMS, same thing with other kind of stocks that you could easily find if you watch my video on how to pick and how to analyze growth stocks. Now here comes my favorite part of the strategy, and this is the part that sets my strategy apart from other strategies. And this is what has allowed me to go down much less than the S&P 500 and the Nasdaq, not just in 2025, 2024, 2023. I was even positive in 2022 because of what I'm about to share today. So it's going to be very important. And I would call it rotation. Although it's not the best name and it's hard to generalize it and it's hard to label it, but I would call it rotation. And it's the basic example that there's only so much money in the market. So if the market's going up, if certain assets in the market are going up, let's say Rocket Labs, the growth stocks, other assets, let's say the boring stocks, will be going down. Not because they are bad companies, but because of money flows. I always give the example of the Nasdaq and Berkshire Hathaway. And back in 2000, Berkshire Hathaway was selling off. Not because it was a bad company, because people were taking their money out of Berkshire and they were putting it in the Nasdaq, in pets.com, into a lot of the speculative growth stocks. Okay? Now, once the cycle ends, which it always ends, pretty much once a year you have some kind of news around the economy or news around something, then all those recession-proof stocks that no one wanted, they will start going up as the market's going down. And if you do buy those stocks, you would kind of be hedging yourself against a market pullback without trying to time the market. And it's a very special strategy, and I'm gonna show you examples. This is a recent one that I bought. It's called AutoZone. Now, before I bought AutoZone, I was making videos, and I was telling you guys, be fearful when others are greedy. I know how that cycle looks like. There's way too much greed in the market. And as Rocket Lab and the growth stocks were going up, the recession-proof stocks that people were dying to buy in April, no one wants them right now. I told you guys, if you go on a screener, you look at 52-week slow stocks, all the recession-boring stocks, they're all sitting there. To me, that's very exciting because I want to buy those stocks right now. People are not worried about anything. But in the next few months, something will happen. Some kind of a bad earnings report, bad jobs number, a bank is going to fail, something with a currency crisis or whatever. There's always a reason. Once that reason happens, those boring stocks that people don't want, they're going to be going up like crazy in a market pullback, and the growth stocks will be going down. Then you would sell those boring stocks when everyone is loving them, and you would buy the growth stocks when no one actually wants them. And this is exactly what I did this year in early 2024. This is a screenshot where I sold pretty much 20% of Lockheed Martin. I had it. I had Cheniere Energy. I sold some of it, and I sold other stocks that were going up as the market was going down. And I told people, I think this is the time to start getting aggressive on growth. That was on April 4th. I haven't bought the dip before April 4th. I was waiting for the capitulation phase, which I've seen it before. I said, from now till Tuesday, I have waited long enough to start buying growth, and I think the time is here. The bottom was pretty much Monday. Now, I did not mean to time it perfectly, but to me, it was very, very obvious that that was some kind of a major bottom, and that was the capitulation phase. And I was holding on those stocks which were going up or holding up as the market was going down. I sold them, and I started buying stocks like Robinhood and other stocks when people didn't want them. And I'm doing the same thing right now. I told you guys about the whole thing with the market, and I bought AutoZone. AutoZone was down 11.5%. Not because it's a bad company, but because people like Rocket Lab and they're not worried about the market. They're not worried about anything. So AutoZone sold off 11.5%. And I bought AutoZone. Since then, it's up 11.5%. But on red days like Friday, AutoZone was up 2.4%, and the Nasdaq and the S&P were down. Why? Because of what I told you in terms of money flows. How the market of the money, it flows constantly from growth to safety, from growth to safety. And if you can play this cycle, you could make a lot of money and you're not timing the market. So I like AutoZone as a long-term investment. But if I know that the cycle is playing out the way it is and the money is not going into the recession stocks, maybe when I'm trying to find an investment, I'm going to find a recession-proof stock that people don't want. And maybe in a few months, when people are loving those stocks and they're trading at high multiples, maybe I want to raise cash from them and buy Robinhood when no one wants it, when I bought it at $32. Or maybe I'm going to buy Rocket Lab in a few months when people will start hating them and people will ask me, what is the best recession stock to buy? But the best time to buy the recession stock is actually right now, because people are not doing it and they're looking for the next Robinhood, the next Rocket Lab. And this is the best time to be doing those things. And I know those things from a book called Mastering the Market Cycle by Howard Marks. People say it's timing the market. It's not. There's a market cycle. It's not easy to predict, but it's the same thing every time. And it starts with optimism, reaches euphoria, goes into capitulation, what I showed you guys when I waited until April 4th, because I know how the capitulation cycle looks like, because I've seen it before. I've been in the market for a while, and I know how those things look like. And we ultimately reach a crazy phase, and then we start going up again. And that's just the way the market cycle works. And I try to play it by buying the recession stocks when no one wants them. When everyone loves them, I try to sell them or trim them. And I buy the growth stocks when no one wants them. This way, I'm always getting prepared for the next big crash or the next big event without trying to time it. And I believe we're in this cycle right now where the best buys are the recession-proof stocks at 52 weeks lows, and it's not the growth stocks that are trading at 60 times sales. And I think you could make a lot of money if you go on any screener and you try to find stocks like AutoZone that sold off, not because they're bad companies, but just because of money flows and because people don't feel like they need to own AutoZone if they can own a growth stock that goes up 50% in a year. That happens near the top. It doesn't really happen near the bottom. And it's very important. Now, the last one, which is also a very important part, but it's not a major part. And it's the whole thing with options. And this is where people tell me, oh, options are too risky. And there's a whole thing on YouTube that options are risky. I'm not saying they're not risky. And I'm not encouraging you to do options. You don't need options to get my returns. Options are a very small percentage of my entire returns. But there's many different strategies on options where it's not too risky. But the whole thing with options is you're getting exposure to a stock without putting a lot of money. I'm going to give you an example with an option I have on AMD. Okay? I bought this option at $100 per share. It costs $735. Now, all this option says that if AMD is at $200 or close to $200, by January of 2027, I will make $4,200 per contract, okay? So in this case, if I'm right on AMD, I will make around 6x. So 6x my money. So if I'm right and it goes to 200, I will add 6% of gains to my portfolio. Now, for me to get this kind of return, I would have to put 6% of my portfolio in AMD at to $100 and wait for AMD to double to 200 to get the 100% on 6%. So instead of me putting 6% of my portfolio in AMD to get a double, I can put in 1% on this option and get 6x my money. So in this way, instead of committing 6%, I commit 1% and I get the same returns. Now tell me, how is this risky? This is how I personally do options. It's the same thing with SoFi. This is another bet where if SoFi is around $34, $35, by January of 2027, I make 8x my money. So $60 become $440 for every contract. Now tell me, how is this risky? To me, it's not risky at all. In fact, it's amazing because I'm committing a small amount and I can diversify with my other money, and I'm also getting the upside. So to me, this is how I do options. This is the most complicated part of the strategy, but I explain all of those things in my own group. I share what I do with you guys, and I pretty much have a 1-hour video explaining to you how to do options. Everything is included. I don't sell anything extra. But if you want to join, you could join my group and get the same returns I get. And we have over 920 members. So if you're interested, you could join if it resonates with you. If not, but I thank you for watching. Hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I'll talk to you in another video.